Hi everyone, welcome back to another session here at Let's Talk Audit and Assurance, and you are currently in round 2 of another MCQ Marathon playlist where we help you crack the audit code with questions for board exam preparations. And yes, you heard it right, this is indeed part 2 of round 2. So if you want to check out round 1, we also have that in our playlist. And if you want to check out part 1 of this second round, that is also readily available in our channel, Let's Talk Audit and Assurance. Now, just as a heads up, I'm currently recording this one without my noise canceling microphones and headset. So that being said, you might hear a little bit of background noise. However, I hope that won't distract you too much from the plan that we have in store today. And that plan, of course, is 25 questions, one goal, CPA success. Let's go. Our first question is actually looking into RA 9298, or the Republic Act in the Philippines that covers the accountancy profession. The short title of which, of course, is the Philippine Accountancy Act of 2004. And the question goes something like this. Which of the following statements concerning the practice of accountancy in the academe or education is incorrect? So recall that we have 4 sectors of practice. We have public practice, commerce and industry, the government, and then the subject of this question, which is the academe or education. And again, we're looking for the incorrect statement. So let's evaluate. Letter A says the position of either the dean or the department chairman or its equivalent that supervises the Bachelor of Science in Accountancy program of an educational institution must be occupied only by a duly registered certified public accountant. And letter A is a true statement. So we are required, in the Philippines at least, that if you are the dean or the department chairman or its equivalent, then you must be a certified public accountant. So letter A is true. Letter B, CPAs are allowed to teach business law subjects. Are we allowed to teach RFBT or law subjects even when we are not lawyers, but we are CPAs? The answer is yes. And so letter B is also a correct statement. Now, sometimes this has caused some confusion with some people who think that you must be a lawyer to teach business law subjects in the BSA program. Now, you are not required to be a lawyer. By the mere fact that you are a certified public accountant, you may actually teach business law or our RFBT subjects. Let us now evaluate the third option. Letter C says members of the Integrated Bar of the Philippines are not allowed to teach business law and taxation subjects. And actually, it is choice C that is incorrect, because as you may have noticed, our lawyers are actually allowed to teach business law and taxation subjects even when they are not CPAs. By virtue, of course, of their profession, they are already lawyers, and so by that, they are allowed to teach business law and taxation. Again, even if they are not CPAs. So the thing to remember here is that CPAs are allowed to teach business law subjects even when they are not lawyers, and lawyers are still allowed to teach law subjects, of course, and even taxation subjects even when they are not CPAs. So letter C is the incorrect statement. Letter D would say that the position of either the dean or the department chair or its equivalent that supervises the Bachelor of Science in Accountancy program is deemed to be in the practice of accountancy in the academe and education, which is, of course, a correct statement. Let's go to the next question. As the acceptable level of detection risk decreases, so we again recall that when we talk about the acceptable level of detection risk, as the acceptable level of detection risk decreases, the auditor actually becomes stricter, right? Because the risk that the auditor is willing to accept has decreased, and so the auditor has become stricter. And when the auditor becomes stricter, the auditor modifies the nature, timing, and extent of their procedures. By nature, we mean that the auditor will choose more effective procedures. By timing, we mean that the auditor will test as close to the balance sheet date as possible. And by extent, we mean that the auditor uses a larger sample size. So since we are decreasing the acceptable level of detection risk, we shall choose the option that reflects a strict auditor. So let's take a look at our options. Letter A, eliminate the assessed level of inherent risk from consideration as a planning factor. And letter A is not the correct statement because we cannot eliminate inherent risk. Remember the risk of material misstatement, which is a combination of inherent and control risk? We even call them the uncontrollable risks. These are risks that cannot be controlled by the auditor, and so therefore we cannot eliminate either inherent risk or control risk. So letter A is not the correct answer. Again, we're looking for the strict auditor. Letter B, postpone the planned timing of substantive tests from interim to year-end. Letter B simply means that the auditor will test as close to the balance sheet date as possible to ensure that the entire period under audit is covered. Is that the mark of a strict auditor? Compare that with an auditor who does an interim testing. Say, for example, tests only 1 quarter versus this auditor who would like to test as close to the balance sheet date as possible to cover the entire year. Does that sound like a strict auditor? The answer is yes, of course. And it's actually letter B that the auditor, or letter B is actually the response of the auditor when the auditor decreases acceptable level of detection risk. Choice C would say reduce substantive testing, and we already know when the auditor reduces substantive testing, the auditor is becoming chill. We are looking for the strict auditor. Letter D, lower the assessed level of control risk from the maximum level to below maximum. Lowering the assessed level of control risk means the auditor intends to rely on the controls or believe that the controls are reliable. And when the auditor believes that the controls are reliable, the auditor may decide to go a little bit more relaxed because according to the auditor, the controls are reliable anyway. And so therefore, letter D is not the mark of a strict auditor. So the only correct answer we have here is bravo. Moving on to the next question. Which of the following is the most effective control procedures to detect vouchers that were prepared for the payment of goods that were not received? So key to this question is that the goods have been paid but the goods were not received. So which one is the most effective control procedure? Let's evaluate our choices. Letter A would say match the purchase order, the receiving report, and the vendor's invoice for each voucher in the accounts payable department. Meaning to say, for each voucher that has been processed for payment, you do the three-way matching. And the three-way matching will be among the vendor's invoice and check if what was billed by the vendor has actually been received, and then match it with the purchase order to determine if what was paid was actually ordered. Now, in this case, when you look for the payment or the request for payment of a particular invoice, you may be able to uncover that there was no receiving report. And so therefore, if there was no receiving report, then the likelihood is that those goods were not actually received. So letter A is looking like a prime candidate for our answer to this question. However, let us still evaluate the other choices. Letter B would say verify vouchers for accuracy and approval in the internal audit department, and we all know that it is not actually the internal audit department that approves the said vouchers. So we're striking out letter B. That is not a correct choice. Letter C, count the goods upon receipt in the storeroom. However, the goods were not received, so there is nothing to count. So letter C can't be the answer either. Letter D, compare goods received with goods requisitioned in the receiving department. But then again, according to the question, the goods were not received. So we cannot compare the goods received because they were not received in the first place. So the correct answer to this one involves the three-way matching of all invoices that were processed for payment. This will help us check if there indeed was a receiving report that signifies the actual receipt of the goods. So the answer then is alpha. Moving forward, auditors apply analytical procedures to the client's operations in order to identify, and to this we recall analytical procedures is actually a procedure that revolves around studying plausible relationships. Okay, so this is all about relationships. What can we identify when we perform analytics? Letter A, non-compliance with prescribed control procedures. Letter B, improper separation of accounting and other financial duties. Letter C, weaknesses of a material nature in the client's internal control. Or letter D, unusual transactions. Now, when we talk about analytical procedures, we recognize that the amounts and balances in the financial statements are interrelated. That being said, analytical procedures mainly look at relationships through the numbers that we see. And non-compliance, segregation of duties, and weaknesses in the internal controls do not necessarily and directly get reflected in the numbers. So Alpha, Bravo, and Charlie can't be the answer. The only correct answer we have here are the presence of unusual transactions, which will be directly reflected in the balances and will then be seen when we perform analytics. So the answer here is Delta. Next, which of the following is not one of the three primary objectives of internal controls? Now, we remember that internal controls help management protect their objectives, and management has a threefold objective. Number one is efficiency and effectiveness of operations. Number two is compliance with laws and regulations. And then, of course, we have the reliability of financial reporting. So not one of the three objectives is the assurance of elimination of business risk, simply because business risk cannot be eliminated. Business risk is the risk that is born out of doing business. It's the risk that management will not be able to achieve their objectives, and that just cannot be eliminated. For as long as you're in business, there will always be business risk. So Charlie is the answer to this question. It is not one of the three primary objectives. Next question. Omitting quantities from copies of purchase orders sent to the receiving department is a control procedure intended mainly to. So we do know that there is a separate department that prepares the PO and a separate department that actually receives the goods, and they are the department that will prepare the RR, or the receiving report. So usually we give them a copy of the PO, and it is an added control procedure for us to erase or remove or omit the quantities of the goods ordered. The question is, why do we do that? Is it letter A, to identify and return damaged goods as soon as they are received? Or B, ensure that goods received are physically counted by the receiving department personnel? Letter C, prevent theft of goods by receiving department personnel. Or letter D, provide a check for verifying the accuracy of the perpetual inventory records. Again, remember, for this one, we are simply omitting the quantities from the PO, and then we send this PO with the omitted quantities to the receiving department. Why do we do that? It is to ensure that they will actually count the goods. Because sometimes if you indicate the quantity there, and if, people in the receiving department start feeling a little lazy, or they're just not in the mood, they may not actually count the goods. So in order to address that possibility, we omit or erase the quantities to force them to actually count the goods received. So the answer to this is Bravo. Next, the audit of year-end physical inventories should include steps to verify that the client's purchases and sales cutoffs were adequate. The audit steps should be designed to detect whether a merchandise included in the physical count was not recorded as A. So let's lock in this concept. What is this question telling us? This question is telling us that there is merchandise, there is inventory that is included in the physical count. This very same inventory that is part of the physical count should not be recorded as A. So we have our choices. Letter A, is it possible for inventory to be part of the count and to be a purchase in the current period? Is it possible? The answer is yes, right? You purchased the inventory in the current period, you were not yet able to sell it, and so therefore, rightfully, it forms part of the physical count. So letter A is not the answer because we're looking for the was not recorded, right? Letter B, is it possible for an item of inventory to be part of your physical count and also be recorded as a sale in the same period? Is it possible for inventory to be both an unsold, right? Inventory is unsold. An unsold an unsold inventory in the physical count and a sold inventory in the records? The answer is no. If that inventory is part of the physical count, then it should not have been recorded as a sale in the same period. If it was a sale in the same period, then it wouldn't have been part of the count. If it was part of the count, then it shouldn't have been recorded as a sale in the period. So letter B is our answer. But to evaluate the other two choices, is it possible for an inventory to be part of the physical count and to be a purchase return in the next year? The answer is yes. You may have purchased it this year, but then noticed the defect by next year and returned it next year. That's okay. Can it be part of the count this year, but then a sale in the next year? Yes. You might have just purchased it now, but then sold it next year, so that is still okay. So the answer here is bravo. Next, going back to RA 9298, this is very specific to the Philippines. No person shall serve the Professional Regulatory Board of Accountancy for more than, and the cap or the maximum number of years is 12. So bravo is the answer to this one. No more than 12 years. Next question. If a company's external auditor expresses an unqualified opinion as a result of the audit of the company's financial statements, readers of the audit report can assume that letter A, all material disagreements between the company and the external auditor about the application of accounting principles were resolved in the satisfaction of the external auditor. Meaning to say, yes, there were disagreements, but these disagreements eventually were resolved according to what the auditor thought is the right thing to do. Okay, they were resolved to the satisfaction of the external auditor. Or is it letter B? The company is financially sound and the financial statements are accurate. Or letter C, the external auditor found no fraud. Or letter D, internal control is effective. So we're referring to the unqualified opinion of the auditor. Now we know that when we give an unqualified opinion, this simply means that the financial statements are free from material misstatements. We do not give an opinion on the financial viability or financial health or the accuracy of the statements. We don't give an opinion on that, so it can't be bravo. And it doesn't mean that we found no fraud because we are saying it's free from material misstatements, whether due to fraud or error. So it is still possible that there was fraud, only that it was not material or it doesn't have a material effect. So it's not Charlie either. And we do not give an opinion on the internal controls, so it's not Delta. So the correct answer to this one is alpha. So since the disagreements were resolved to what the auditor thought is the right thing to do, and of course the auditor will always follow what that the financial statements should reflect what PFRS requires. So therefore, in that case, the auditor will be happy and will give an unqualified opinion. So the answer to this is alpha. Next, which of the following procedures is not used by the auditor in testing subsequent events? And to this, we are reminded that subsequent events are events that occur after balance sheet date and up to the date of the auditor's report, and events that become known to the auditor after the date of the auditor's report. So we have mentioned previously that there is a big difference in the auditor's responsibility with regards these two timelines. If you're referring to a subsequent event after balance sheet date but on or before the date of the auditor's report, then the auditor has the responsibility to obtain sufficient and appropriate evidence. But for facts that become known after the date of the auditor's report, the auditor does not actually have a responsibility to obtain sufficient and appropriate evidence. Rather, the auditor simply waits for information to come to his attention. Okay, so that's our mini review on subsequent events. But anyway, let's go back to the question. Which is not a procedure in testing subsequent events? We have letter A, discuss with management the current status of items in the financial statements that were accounted for based on a tentative, preliminary, or inconclusive data. Letter B, make inquiries regarding the prior year's financial statements covered by the auditor's prior year audit report. So assuming, for example, that you are testing the 2024 period, okay, with balance sheet date December 31, 2024, letter B would say inquire about 2023. That is what letter B means. Letter C, review available interim financial information, say for example in the first quarter Okay, if you are auditing 2024, maybe there is already a 2025 quarter one report that's available. So you're going to review that. And letter D, read available minutes of meetings of stockholders and directors. So again, subsequent events or events that occur after balance sheet date. So therefore, we don't actually backtrack. We don't look back to 2023 if we are auditing 2024. We should be looking forward to 2025, right? So the incorrect or the not a procedure here is Bravo. Because Bravo is looking back instead of looking forward. So Bravo is the answer to this one. Next, of the following, which is the most efficient audit procedure for testing accrued interest earned on bond investments? We're talking about accrued interest income. Letter A, recomputing interest earned. Letter B, tracing interest declarations to an independent third-party source. Letter C, vouching the receipt and deposit of interest checks. Or letter D, confirming interest rate with the issuer of the bonds. Take note that while we are talking about accrued interest income, we are also being asked for the most efficient procedure. And I think you are able to spot it. The most efficient procedure, of course, is letter A. It's the audit procedure of recomputation. So recomputing interest earned is the answer to this one. Next, the expected population deviation rate of client billing errors is 3%. The auditor has established a tolerable rate of 5%. So notice the relationship between these two, or the implication of having these two figures. The auditor is willing to tolerate up to 5%, and the auditor only expects 3%. Okay, error. And so therefore, in this case, the auditor could perform audit sampling, right? As compared when we reverse the two, what if we are saying that the expected deviation rate is 5% and you are only willing to tolerate 3%? So per the expectation, you would already expect that the deviation rate would exceed whatever it is that you're willing to tolerate. Therefore, if we swap these two figures, if we make the expected 5% and the tolerable 3%, then the most likely conclusion or decision of the auditor is to no longer perform tests of controls and will just expand substantive testing, right? Because even before the actual control testing, the auditor already expects the deviations to exceed what the auditor is willing to accept. But luckily for us, in this case, the auditor can perform sampling because the tolerable is 5, the expected is only 3. Okay, so anyway, this is a test for client billing errors. So in the review of client invoices, the auditor should use letter A, discovery sampling, letter B, stratified sampling, letter C, variable sampling, or letter D, attribute sampling. And to this, we do recall our two sampling plans. We have the attribute sampling plan, which refers to a sampling for attributes. It's a sampling for characteristics. And the other one is a variable sampling plan, which is mainly utilized when the auditor is testing for variances related usually to substantive testing. So if what we are interested in are billing errors, okay, then therefore the most appropriate one to use will be to test for characteristics. Characteristics, are these being approved? Are these being reviewed? And so therefore the correct answer will be to utilize attribute sampling. So that should be delta. Next, for which of the following audit tests would an auditor most likely use attribute sampling? And again, attribute sampling is a testing for characteristics normally attributed to tests of controls. Letter A, inspecting purchase orders for proper approval by supervisors. Letter B, electing accounts receivable for confirmation of account balances. Letter C, determining that all payables are recorded at year-end. Or letter D, making an independent estimate of recorded payroll expense. Of the four choices we have here, which one is most likely a test of control? And the answer is letter A, inspecting purchase orders for approval. So technically, you're testing for attributes. You're testing for characteristics. So the answer is alpha. Next, inherent risk is defined as the susceptibility of an account balance or class of transactions to errors that could be material, assuming there were no related internal controls. And we have to remember that one. When we talk about inherent risk, the assumption is that there are no controls in place. Of the following conditions, which one does not increase inherent risk? Does not increase inherent risk. Letter A, the client has entered into numerous related party transactions during the year under audit. Letter B, the client has lost a major customer accounting for approximately 30% of annual revenue. Letter C, the board of directors approved a substantial bonus for the president and the chief executive officer and also approved an attractive stock auction plan for themselves. Or letter D, internal controls over shipping, billing, and recording of sales revenue is weak. Remember again, when we talk about inherent risk, we assume that there are no controls in place. And so therefore, the answer to this, when we are asked which one does not affect inherent risk, is delta. Because delta is all about controls, how the internal controls are weak. And inherent risk assumes that there are no controls. So this couldn't possibly affect inherent risk. So the answer is delta. Next, we talk about an auditor's decision about dual dating the audit report. So if you must recall, this is related to subsequent events. When the auditor dual dates, the auditor makes reference to two dates. The first date being the date of the original date of the auditor's report, and the second date being the date of the subsequent event. Such as, for example, when we say April 10, except for note 5, which is dated, say, April 17. Okay, so April 10 is the original date and April 17 is the date of the subsequent event. Notice that when the auditor does that, the auditor's responsibility is up to April 10 and April 17. So the intervening period from April 11 to 16 is not included in the auditor's responsibility. Okay, that's the beauty of dual dating. So when the auditor decides to dual date, okay, this reflects the auditor's willingness to, letter A, accept responsibility for subsequent events, letter B, extend auditing procedures and assume responsibility for a greater period of time, or letter C, assume responsibility for events subsequent to the issuance of the auditor's report, or letter D, permit inclusion of a footnote or a disclosure captioned event unaudited subsequent to the date of the auditor's report. Now, please remember that when we talk about subsequent events, the responsibility for these still rests with management. It is never the responsibility of the auditor to identify and report subsequent events, right? So when the auditor decides to dual date or not, the auditor actually considers their willingness to extend the auditing procedures. Because remember, the auditor has to obtain sufficient and appropriate evidence up to the date of the report. So it's a reflection of the auditor's willingness to extend audit procedures. So the answer to this is bravo. Next, what is the element of the audit planning process most likely to be agreed upon with the client before implementation of the audit strategy? Is it letter A, the methods of statistical sampling to be used in confirming accounts receivable? Do we have to agree this with our client? Or bravo, the evidence to be gathered to provide sufficient basis for the auditor's opinion? Do we have to agree this with the client? Or letter C, pending legal matters to be included in our inquiry of the client's attorney. Again, is this something that we have to agree with the client? Or letter D, schedules and analysis to be prepared by the client's staff. I think you're able to spot the answer already. The correct answer is delta, right? We do have to inform the client what schedules we need from them. And so this is something that we agree with the client in the planning process. Next, which of the following is true regarding reportable conditions or those conditions that we report to TCWG? Okay, letter A, they must be included in the financial statements, or letter B, they must be disclosed in the footnotes, or letter C, auditors must search for them, or letter D, auditors must communicate them to the audit committee. So the audit committee, of course, being an added control in one of the branches of TCWG, or those charged with governance. So the answer to this, of course, is delta. that these must be communicated to the audit committee. Now, examples of reportable conditions or matters to be communicated to TCWG, of course, are significant findings. And part of the significant findings would be, for example, when the auditor has observed a material weakness in the client's internal controls. These are definitely not included in the FS. They will not be disclosed, and we don't search for them. But once we find them in the course of our audit, we're able to stumble upon this information, then we of course have to report to the audit committee and or TCWG. Next, financial statement users often receive unreliable financial information from companies. Which of the following is not a normal reason for this? We are talking about information risk, or the risk that the information you receive is not completely accurate or contains misstatements or may be misleading. So which of the following is not a reason for information risk? Letter A would say, well, there are complex business transactions. Letter B, lack of first-hand knowledge about the business or a remoteness of information. Or letter C, there could be large or voluminous amounts of data. Or delta, each of these choices is a common reason. And actually, the answer is delta. Each of the three choices we have just mentioned contribute to the possibility of information risk. So this should be delta. Next, we talk about the four major steps when we conduct the audit. These are number one, testing internal controls. Number two, audit report. Number three, planning. Number four, testing transactions and balances. What is the proper sequence? The proper sequence will, of course, be to start with planning. Then after planning, TOC or test of controls. After test of controls is STOT or substantive test of transactions. And of course, substantive test of balances or STB. And then after that, of course, we can then release our date, prepare, date, and release our audit report. So the correct sequence is 3, 1, 4, and 2. And that corresponds to choice delta. So 3, 1, 4, and 2. Next, it exists when other information contradicts information contained in the audited financial statements. Is this a material error, a material inconsistency, a material deviation, or a material misstatement of fact? Now, when the inconsistency or when the contradiction occurs between the other information and the audited financial statements, we call that one material inconsistency. However, when the contradiction occurs between the FS or the audited FS and information not related to the FS, if it is not related to the FS, then we call that one a material misstatement of fact. As a result of tests of controls, an auditor over-assessed control risk and increased substantive testing. So when we talk about the auditor over-assessing control risk, this simply means that the auditor assessed control risk too high. We didn't say that the auditor assessed control risk correctly high. We're saying that the auditor assessed control risk too high. So this over-assessment would then mean that the auditor did not rely, because again, controls are assessed as high, too high, the auditor did not rely on the controls when in truth they were actually reliable. Had the auditor tested the entire population, the auditor would have seen that the controls are reliable. But because the auditor only performed sampling and the results of the sample showed that the controls are not reliable, then the auditor ended up not relying. Okay, so that's the whole gist of this question. So this over-assessment occurred because the true occurrence rate in the population was, letter A, less than the risk of under-assessment in the auditor's sample. Letter B, less than the occurrence rate in the auditor's sample. Letter C, more than the occurrence rate in the auditor's sample. Or letter D, more than the risk of understatement in the auditor's sample. So if we're going to simplify this whole question, we're basically saying, had the auditor known the true state of the population, then the auditor would have seen that the deviations found in the population are less than his tolerable deviation rate. And because it's less than the tolerable deviation rate, then the auditor would have relied on the controls. But because the auditor performed sampling, in the sample, the auditor found deviations that breached or exceeded his tolerable rate. And because the deviations in the sample exceeded the tolerable rate, then the auditor thought that the controls are not reliable. So on the one hand, you have the population, and on the other hand, you have the sample. So in this case, the true occurrence rate in the population actually was less than. Okay, but the question is less than what? Is it less than the risk of underassessment in the auditor sample? When we talk about less than the risk of underassessment means that you relied on the controls when they were not. So this is an example of a type 2 risk, no? And then letter B, less than the occurrence rate in the auditor sample, you're referring to the deviation rate found in the sample. So the occurrence rate of the deviation in the population was actually less than the occurrence rate in the sample. Had the auditor tested the entire population, he would have seen that. But because the auditor simply tested the sample and was not able to see the true state of the population, the auditor ended up not relying on what would have been reliable controls. So the answer to this is bravo. Next, an auditor confirms a representative number of open accounts receivable as of December 31. So when we say open accounts receivable, this means these are receivables with balances. They have not yet been settled. They have not yet been paid. So open accounts receivable as of December 31 and investigates respondents' exceptions and comments. By this procedure, the auditor would most likely to learn of which of the following. Letter A, the credit manager has misappropriated remittances from customers whose accounts have been written off. But if you think about it, if the accounts have been written off, they will not be part of the open AR balance as of December 31. But what the auditor is examining here is the open AR as of December 31. So you can't see letter A in this question because letter A again refers to written off accounts. Okay, so the answer is not alpha. Letter B, one of the sales clerks has not been preparing charge slips for credit sales to family and friends. Simply put, that one of the sales clerks have not been billing family and friends. So if this sales clerk has not billed family and friends, that means that it was not actually recorded as an accounts receivable. And because it wasn't recorded as an accounts receivable, it wouldn't belong to the open AR file. So letter B is still not the answer. Letter C, one of the cashiers has been covering embezzlement by lapping. Now, if we remember the fraud of lapping, then this is where the employee applies or misapplies a collection from one customer to another customer in an attempt to cover up an embezzlement. So in this case, the accounts receivable of a particular customer would likely still carry a balance. And because it still has a balance, it will form part of the open AR file when in fact that customer has already fully paid. So letter C is actually the answer to this one. Okay, when the auditor examines the open AR file, the auditor would likely see possibly see embezzlements by lapping. If we evaluate letter D, one of the computer control clerks has been removing from the data file all sales invoices applicable to his own account. If the computer control clerks has done this, then his sales or his account would not be part of the open AR file because he has removed all of the data files. Okay, so the key here is to look for to look for a situation where it will still form part of the open AR file. So as it happens, Alpha, Bravo, and Delta will no longer be part of the open AR file as they have either been deleted or written off or not prepared at all or not recorded at all. So that's why the answer is Charlie. Next, holding other planning considerations equal, an increase in the amount of misstatement in a class of transactions that an auditor could tolerate. In other words, we are dealing with an increase in tolerable misstatement. Okay, so what happens when the auditor increases tolerable misstatement? The auditor actually becomes relaxed because you're increasing the amount of misstatements that you are willing to accept. So you are entering a Zen state, a more relaxed state. it in a chill mode, for if you may. Now, so in this case, which of the following choices would reflect an auditor who is in a chill mode? So letter A, increase the extent of auditing procedures to be applied to the class of transactions. Remember, again, we're looking for the chill auditor. Letter B, perform the planned auditing procedures closer to the balance sheet date in order to cover the entirety of the year. Or letter C, increase the assessed level of control risk for relevant financial statement assertions. Or letter D, apply the planned substantive tests prior to the balance sheet date, meaning to say the auditor will consider performing an interim testing instead. So of the four, which one reflects a chill auditor? The answer is delta, right? Performing interim testing rather than the whole year or year-end testing is a mark of a chill auditor. Notice when you read through Alpha, Bravo, and Charlie, you would notice how frantic the auditor has become, how strict the auditor has become, right? But in Delta, auditor enters a Zen zone. So that's Delta for this number. The primary concern in testing payroll-related liabilities is to make sure that, and we recall as a general rule, whenever we talk about assets and revenues, the auditor is concerned with overstatements. Whenever we talk about expenses and liabilities, our concern is understatements. And so therefore, the answer to this question is letter A. We are going to make sure that there are no understated or omitted accruals. Now, valuation is not much of a problem when you talk about payroll-related liabilities. So, for example, when you talk about unpaid payroll or accrued payroll, these are generally straightforward in terms of computation and valuation. The recording of the transactions in the proper period or cut-off may be a concern, but then this is not the primary concern. Because again, if it's expenses or liabilities, what we are most concerned about is understatement. So alpha is the answer. Next, which of the following statements best describes why an auditor would use only substantive procedures to evaluate specific relevant assertions and risks? Meaning to say, in this case, the auditor has chosen a no-reliance approach. A no-reliance approach means the auditor will no longer test the controls and will focus solely on performing substantive tests. So which of the following is the best reason why the auditor would do this? Letter A would say the cost of substantive procedures will exceed the cost of testing the relevant controls. But then if you take a look at letter A, it doesn't make sense, right? If the cost of substantive procedures will exceed the cost of testing the relevant controls, the auditor will most likely be dissuaded from performing an all-out substantive approach. Letter B, the relevant internal control components are not well documented. But in this case, we do have to remember substance over form. So even if they are not all well documented, but if they are functioning and are being observed, that might still be a basis, right, for the auditor to consider if the controls are reliable or not. Letter C, the internal auditor already has tested the relevant controls and found them to be effective. Okay, so does this make sense? Because the internal auditor has already tested the controls, we would then perform an all-out substantive approach. Well, number one, while we may utilize the work of the internal auditor to assist us in our own audit, we cannot actually delegate our work to them, and we still have to corroborate or confirm, okay, their work. So we can't just take it at face value. So letter C also sounds kind of off. Or letter D, testing the operating of the relevant controls would not be efficient. And letter D is actually the answer. Now, we do recall when the auditor assesses control risk, the auditor would determine or would look at the design and operating effectiveness of the controls. If the design and operating effectiveness appear to be promising, the general rule is that the auditor would then perform tests of controls. But before that, the auditor actually has to make a pit stop first. Okay, looking into the cost effectiveness of testing the controls. So in this case, even if the design and implementation are good, but if testing the operating effectiveness is not efficient, then the auditor would likely go for a full-on substantive approach. And that's it. We have completed the 25 questions for part 2 of round 2. I'm sure that you are very ready for part 3. So once you're there already, if you think that you could already handle part 3, then just look for the next video. But if you would like to take a short rest, then that would also be perfectly fine. So I hope to see you guys in part 3 of round 2 of our MCQ marathon.